All the pretty girls involved with me, making pretty love to me, pretty, pity, pity. Oh, I can't feel a thing. I can't feel.
Searching for music for your next video? Then you need to check out our.
I didn't fit it, but I rock it like a baby in the car.
All right, we got the Fed. We've got the Fed interest rate decision coming real soon. So, as we always do, I'm gonna just get straight to it. Hold on, guys. Cause I walk around with the bank on him. Show them Gangnam Style, put the gang on him. Twist my fingers up on a bang on him. Alright. We're live. Alright, so let's take a look at the dollar. Alright, let's take a look at the nearest areas of liquidity. Right, so on the hour, we've got Tokyo's low from yesterday, or last night. This is a pretty nice area for price to actually head down into. And then on top of that, right, we've got this weekly imbalance down here. And we've also got this gap. Okay, this market open gap. Right, so ideally, I want to see us draw towards this gap. Right? Like, I want to see us fill some of it. Let's just say the dollar is going to continue being bullish, right? Because we can see here on the weekly, we've had a nice little reaction. It looks like we are going to head up higher. Fine. If that's going to be sufficient enough, we actually need to see this daily lower high get broken to create a new daily high for us to get a pullback and a continuation. Okay, that's what we need to see. So in terms of today and, you know, the Fed speaking, I kind of want to see market head lower and then reverse to the upside. That's what I want to see, but we'll see what happens. Okay, now areas that are a little bit closer. Okay, we've got this low, this high here. Okay, so they've kept the interest rate the same. That should mean gold should be clapping down. Yep. Alright, so far we've had a pretty strong push lower. Right, we're about to hit final TP on this move. Let me just move my TP. This is looking pretty heavy. See if I can't catch as much of it as possible. What is this TP? 2745, yeah. 2745. It's around here. Okay, so pretty strong push so far. What are you guys looking at the moment? Just gold with me. If you're on the live stream right now, drop a like on the live, guys. Drop a like on the live. Money day, everyone. Alright, so we're getting a continuation right now. It's okay. Obviously, we all know, or should know by now, that the main move is Fed's speech, not necessarily the interest rate. Obviously, the interest rate, we are going to get a little bit of a reaction, but the main hitter is going to be the press conference. Okay, with Mr. Jerome Powell. But so far, if we get like a potential drop here, we could still come for these lows. These lows are still likely. US 30 is dropping as well. Let's see Bitcoin. A little drop on Bitcoin. Nothing too crazy. Wow, big wick on Euro USD. Let's take a look at the S&P. It's okay. It's nothing crazy. Just getting a quick idea of what's going on in the markets. EU's dropping, GU's dropping. To be honest, GU needs to drop more. Right, GJ is pushing up. USD CAD is also pushing up. What's happening, Gift? I'm not gonna lie, I did take like most of my profits off at 1 to 2R. But now looking at the price action, I'm thinking, damn, probably should have kept it on. You know, the thing is, even when I look at gold, like, this is a pretty bearish move, you know? Like, we could be bearish for quite some time. Especially on the daily. If we get today engulfing yesterday's daily candle and maybe potentially Monday's candle, oof. Then for most of the week or the rest of the week, it's pretty easy the direction that we're going to head down towards. Right? So then let's just say today's Wednesday, so tomorrow Thursday, all we're looking for is a pullback and then a continuation lower. Like, it's real simple once you get to that point. Bitcoin's tanking. I mean, Bitcoin's coming down, but tanking is a bit wild for you to say, bro. You know, when you tell me Bitcoin's tanking, I'm thinking of a move like this. This is a bit of a tank. Right? This is a tank. This is a pump. But these smaller, you know, fluctuations in price, I don't really count them, I'll be honest. Alright, there goes gold. Dollar's strong. Dollar's very strong. So got me doing things. Bloomberg. Bloomberg Live.
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with CME Futures.
Restrictive. I don't think it is anymore. I don't think you can look at this data and call it meaningfully restrictive.
One of the joys of Columbia Economics is the gentleman with the bright spot,
All right.
Xavier Saleh Martin. He's expert on growth economics.
So if gold is going to keep dropping, right, we have this area it needs to work through. This whole area here, it needs to work through it, right? This is going to be, was watching on the 5 minute, but it reversed. Okay, cool, bro. Guys, if you're watching the live stream right now, just do me a big favor and drop a like on the live. Right? You guys are the ones that are putting in the time to really earn some valuable XP. Do you understand? For all those people that are not here, you know, when they're trying to get to the next level, they need to be at, you know, looking at the markets at these times, right? The more time you spend looking at something, the easier it becomes. So right now, yeah, guys, drop a like on the live, by the way. So right now, we're seeing the dollar push. Let's see.
How do we get out to June? I mean, you got to view first half, second
Like,
half.
ideally, overall, the target of the day, like I told you guys during the New York session,
In April,
is going to be that daily high from, what's this, Monday?
have to look at
Oh, sorry, last week Thursday's high, okay? That's the target for today.
quite a bit.
If we get it today, if we get it tomorrow, it's fine, but that's going to be the main target.
Also hear from our research analysts that businesses are investing more in CapEx. So it feels as though businesses have certainly absorbed the higher rates. It's also starting to feel like consumers have absorbed the higher rate regime. I think housing will be critical there. We'll see how housing does in the spring, but our expectation is it actually picks up from here.
Some aggressive pushback from Neil Datta of Renmark, who writes in and says the following: hawkish and complacent. Goes on to say that
30-year yields are up.
that the dominating risk is a passive tightening of monetary policy. The Fed is remarkably complacent. I don't agree with their economic outlook. Housing is a mess. Wage growth is slowing. Core inflation is likely to ease in the months ahead.
What are you guys thinking so far of the dollar?
Comes more
What's your
into
thoughts? What's your
focus.
opinions?
Why do you disagree with that?
Well, I don't really disagree with any of that. All he's talking about is the economy
Let me know, guys.
continuing to
And
go
who's on this
through a
live?
soft
Who's on this
landing.
live?
We've got inflation. We'll get core PCE in the next few days. That year over year is 2.8%. You could take the 3 and the 6 month, it's at 2.3, but it's not 2%. And Rich talked about tariffs in 2019. That was a much lower inflation regime. We were sub 2%.
Yeah.
Now we're over 2%. So I think the Fed would like to keep rates here until they see inflation actually down at 2%.
Let me put something on the table. We could get some good news on inflation for 3 or 4 months. The year-over-year comps will actually be favorable to those calculations. We could be looking in April at inflation running in the low 2s, and then the question will be, why aren't you cutting? So again, 3 and 4 months of data can change sentiment and potentially the Fed's outlook pretty notably, I think.
You both asked great questions,
Your
gave
state is still
journalists good
dropping.
questions to ask. You were asking what would it take to hike rates, put that back on the table. And Bob, you asked, are rates meaningfully restrictive because you don't think that the evidence points to them being so. Rich, would you agree?
Gift says in the
Based
chat
on
box,
economic
dollar's still
data,
looking
it
strong
is
right now.
hard to say that rates are meaningfully restrictive despite what you're seeing in the housing market and despite the normalizing that you can see in some pockets as potentially weakness.
Well, certainly rates are less restrictive than they were. I judge that they still are restrictive.
Damn, earlier, guys, I really should have noticed this imbalance higher before I placed that sell around here. I really should have noticed that. Because after we entered and I saw this area, I was like, oh, not gonna lie, this area is looking a little bit better.
The soft landing, and you could have a Powell Fed saying we want the soft landing, but no more rate
You know,
cuts. That
and
would change
when you look
financial
close at the
conditions.
area,
I'm going to say something that
you
might be
refine the
somewhat
imbalance down.
unpopular
We had a
around
perfect
this
play
table.
inside this 5-minute
I
area.
would sense, and I think a lot of people watching might feel the same and listening too, that this is convenient
fine,
framing
it
to
happens.
insulate themselves from political criticism. That back in December, Chairman Powell made such a hash of it in the news conference.
Dollar's
and
really strong.
Criticism about whether they were anticipating policy changes and whether it was the incoming Trump
Are we gonna get a new
administration
daily
that
low
changed
low?
their stance.
We'll see.
And now they get to put out a statement that says, no, this is about elevated inflation and a solid.
It's just
labor
about waiting
market.
for the main
How
man
much
to
has
come out, man.
changed in the last 5-6 weeks? Has that much changed in the last 5-6 weeks? Why didn't they make this argument back in December? Is this about policy or is it about the data?
Well, maybe we will find out in the press conference when someone asks Fed Chair Jay Powell just that. I will say it seems like it's going to be an increasingly politically delicate situation for Jay Powell. I'm curious to see whether he just answers. I'm saying.
This is one way of insulating the committee from that criticism. You can just point to the statement and say it's about inflation, it's about the data, and we're not talking
This is
about
dropping,
policy.
man.
Well, and at some levels, some of the members probably feel that way.
It'll be really interesting to see what we do here. Like, this area here, I'm not sure what we're going to do.
Say that the flipping
Like,
and
we
the
can definitely
flopping,
start pushing
there
up from
should
there,
be
but
at some point an anatomy of what happened.
You know, especially when I look at the
Time to
4-hour
really
candle.
understand exactly what the deliberative process is. At the
It's
Federal
like,
Reserve.
okay,
Rich can tell us
cool.
what he really thinks in a commercial break.
You
that
know,
starts
we could
in
get a
about
pullback
an
to
hour's
test
time
this 4-hour
after that
candle's
news
low.
conference is finished. Do you want to share
Right,
it now?
because this 4-hour
Well,
candle started at 3.
As I said, they made the judgment in September. The
3,
labor market was softening. The
4,
Somme rule had been
6,
triggered. They had
8.
good inflation numbers. I actually think it's no more complex
4,
than it is data dependent.
6,
And in particular,
7.
they were disappointed that there was
Wait,
not more progress in
am I
inflation.
bugging?
You are completely
4,
right, Lisa,
5,
that
6,
the
7. So
comments on,
this
is there
4-hour candle's going to close
placeholders, the
now.
staff forecasting, what do people factor in?
Right, at the end of
We
this
now know from the
hour.
minutes that, in fact,
So
the
at 8,
placeholder
the new
was in
4-hour
staff
candle's going to open.
forecast and in many of the participants. And so,
So let's see,
you know,
half
that's
hour.
another consideration as well. I'm sure he'll be asked that.
If you are just joining us, welcome to the program. Equities declining by 0.8%. This was meant to be a non-event, turning out to be somewhat of an event. Rates unchanged, but with a hawkish bias in the statement. Bond yields are a little bit higher off the back of it as well. If you
S&P's
check out the
coming down,
2-year,
man.
10-year and 30-year, going into this decision and the release of the statement, yields were higher by a couple of basis points, now up by 5 on a 10-year to 4.58. Diane Swank of KPMG joins us now for more. Diane, welcome to the program. Your early reaction to that statement, please.
Well, it is a little bit hawkish, and I do think it's well expected. I agree with Rich that this is in response to the data. We got a better employment report than expected at the end of the year. That is factored into the statement with the solid. We've also seen that inflation, the path down is much slower than the path up, and the last mile has looked a little sticky. I also agree with Rich, though, that we could get some very good inflation data in the first 3 months of the year, January, February, and March. And that will be interesting because not only is it the year-on-year comps, but they're changing the seasonal adjustment to the personal consumption expenditure index, which the Fed targets. That's important. What the
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with
On the flip side, there's policies they see as disinflationary, deregulation, and
All right, we've got 15
cutting
minutes.
government spending. And until we know the sequence of policy, the magnitude of policy, the Fed can't front run that, even though they're doing
Yep,
simulations
I
on
know
it.
trading is
And the
boring.
magnitude is
You know,
different
you
today
tell
than
people
it
trading is
was
boring, they
in
don't believe you.
2018 or 2019. I think the other important issue is that the
They don't
embers
believe
of
you,
inflation are
but that's
still
the truth.
burning. This is not a situation where
Nvidia's
they've
dropped another
already
6%.
defeated inflation. So it makes sense, again, behind the data. I think they'd like to be more forecast-oriented
Nvidia's down
in
bad,
their policy
guys.
setting, but I don't know how they can
Trump
be,
keeps
'cause
killing it.
one, we don't know the sequence of those policies, and
We had that
two,
huge drop
it's
come market
important that
open,
the US
about
economy
20%.
has humbled the Fed more than
And
once.
now with what
Jason,
Trump is
Di-
doing, it's
rather,
dropping
Diane,
even
you
further.
stopped me cold today with the Jason Furman chart going
I'll
back to
tell
the
you
30s,
what,
the analog back to Smoot-Hawley as well.
it's not the
There
end of the
a lot
world.
other noise going on as well, but the answer is the
Back to all-time
the
highs,
unspoken
about
here is disinflation.
26%
and not
return.
the fear of outright deflation, but just
It's not looking
a
good for them,
slowing
bro,
of the economy,
honestly.
which gets you, frankly, to a Bob Michael lower yield environment. Discuss the analog you have
Look at that
back to
gap.
the
That gap
30s
is
and
huge.
tariffs, as you showed in the Furman chart today.
Well, you know, Jason had put that out there a long time ago. It was really important was that we had a major tax hike in the form of tariffs, the Smoot-Hawley Tariff Act of 1930, after we were into the Great Depression, which tipped off a trade war with 25 countries and a 67% collapse in global trade. And that was important because it added insult to injury and pushed us further into the depths of the Great Depression globally and helped to sow the seeds of World War II. So that was very important. It was already in the context of an environment where disinflation and deflation was occurring. That is not the case today, and that's why, you know, but we don't know. There's still a lot of uncertainty, as Rich pointed out, about which policies happen first, you know, which is more weakening, which is more inflationary, or what is the one thing we've not talked about, what's stagflationary out there? That is a possibility, and I think that's important too, and the Fed is looking at this saying, listen, we're looking at the data. We've got the data in the last 5 weeks. We've gotten data that justify that statement, and that's it. Period. Full stop. Wait and see.
I want to bring you into this because there is a question around scenario analysis and how this Federal Reserve is going to analyze the ramifications of tariffs at a time that otherwise is somewhat inflationary. What would you say to that? Do you have a sense of what that scenario analysis looks like?
Well, They're probably looking at more than one, and they have to factor in retaliation, no retaliation. They have to factor in how much does the dollar adjust. They have to factor in how much do U.S. companies piggyback off the tariff for domestic companies to hike. So if I were there, I'd probably say they might be looking at 4 or 5 different scenarios, and then in the end, you sort of put a weight on them to give you your forecast. I don't think they're at that. My sense is they're probably not at that point yet in terms of detailed probabilities on each, but they're starting to go down that road, I think.
The Fed is in the best position it's been for 20 years. Think of it this way. If something goes wrong with policy, either rates are too restrictive for too long, or something comes out of the administration that causes the downside and unemployment goes up a lot, they can cut rates a couple hundred basis points from here. They've got plenty of room to do that. If the other happens, and actually there's a reacceleration in growth. We're in too much of a pro-growth mode, the golden age of America, and inflation starts to tick up. They can hike rates 100 basis points or so. It's been a long time since the Fed has had that capability to react in either direction.
Dan Swank, I want to give you the final word just on that conversation. Bob Michael says it's the best position this Fed's been in 20 years. Do you agree?
Wow, that's very positive.
No. That's an easy answer.
Let's see what she says.
This is a very hard situation for the Fed because they can't be preemptive. They can't forecast it because they've got to wait for policy and react to it. And then they've got to figure out the one scenario that's not in there is a stagflationary scenario, which I don't think we get to unless we have a really big policy mistake until 26, 27. And one would hope that we'd see a course correction before then. But that is one of the scenarios you have to put into this equation. And that other issue on the expectation of inflation, both in terms of consumers expecting it now with a muscle memory that they didn't have before, the willingness to buy ahead of tariffs once they see tariffs out there. That is a different situation than we had in the 2010s. And the fact that companies have already raised prices through this cycle where we didn't have that in the 2010s. No one even thought of raising prices except for the things that were tariffed, which were passed on or bought with them, like dryers with washing machines. So I think we really have to look at this as a very different scenario. And to me, it doesn't feel like the easiest place at all for the Fed. It's one of the harder positions for the Federal Reserve to be in.
Dan, I think that's probably the difference between economists and market participants right now. Explaining that one. Dan Swank there of KPMG. Matt Lazzetti at Deutsche Bank is an economist, and Matt Lazzetti joins us now for more. Matt, you came out last year, one of the first to do so, and said no rate cuts in 2025. Do you think this statement today, this afternoon, sets us up for that?
Well, I think the statement moves in that direction. It's a mark-to-market of the data that we've seen since the December FOMC meeting, and I think it acknowledges that the Fed is feeling a bit better about the labor market, the downside risks that they were worried about there last year.
Wow, Bitcoin is dropping.
Really gone, but they've diminished.
Bitcoin is dropping, Gifts.
Progress on inflation over the past several months. But the reality, and as part of this,
Bitcoin's coming down.
we're going to see big changes in data flow over Q1 and over the coming quarters, and we have a lot of policy risks that are out there, especially from the Trump administration. So while it does lean in that direction, reduces the probability of near-term rate cuts, I think the Fed will have to see how these policies shake out to really know how policies are going to...
10 more minutes. 18 matches, Champions League tonight. Guess everyone else is tuned into that, lol. Has it started now? I thought it starts at 9. The games. When did the game start, bro?
Productivity, you know the drill. And we got another
8 p.m. Okay.
Writes about for Bloomberg, flat on their back. How does Powell handle that with this new president, this bipolar America?
Well, I think it's been an emerging fact of life in the U.S. economy for decades. The numbers I like to look at are, 2/3 of Americans own their own home. That means a third don't. More than half of Americans own stocks, meaning the other half...
You're not bothered United's playing tomorrow. I mean, I'll probably watch some of it, I'm not going to lie. I'm only going to give the Fed half an hour to do something.
Can do about it, but it creates a challenge in terms of navigating sentiment, for sure.
Well, Matt, just to go to you on this, we were talking about whether the Fed is in a really good position, as Bob Michael was saying, or whether, as Diane Swank said, a really uncomfortable position because they're stuck between a rock and a hard place in terms of what their effect to to Rich's point is on the overall economy versus markets and how much they really are potentially facing off risks that they can't counter. Do you think that the risks are skewed higher to them missing an inflationary boom and not getting ahead of it, or to allowing the economy to deteriorate more rapidly by not cutting rates sooner?
Yeah, look, I think that
I wonder what gold's gonna do here, guys. Really.
I think that was the appropriate step to take over.
I wonder what gold's gonna do here.
At the same time, growth is strong, the labor market's resilient.
I really wonder.
Cut rates further from here. So I do think that they are well.
Right now, it doesn't seem, well, on the lower time frame, doesn't seem like the dollar is going to shoot for these lows just yet.
Hike rates if they have to at some point, although that will be, I think, highly disruptive to markets.
But us leaving this gap behind is a bit odd. Obviously, we've got this gap as well.
And fiscal policies are immense.
But let's see.
And so I think specifically for today, probably March and maybe even a little bit further, it makes sense for them to take a step back. There's no real need to take a policy action in either direction at this point in time, and to see how those uncertainties kind of.
There goes gold. Gold's gonna start blipping.
Also mentioned, as we look ahead, even if inflation comes down to call it 2.25% or so, what is the reason to be cutting rates if the labor market is strong and growth is resilient and financial conditions are easy? So that's part of our view for why we see the Fed on hold this year.
Matt, for people who aren't familiar with your complete outlook for 25 and beyond, can you just share with us your view for real GDP, for unemployment, and your working assumptions around policy from the Trump administration and how they influence or not your outlook?
Yeah, so for this year, we expect the continuation of sturdy growth. We have 2.5% real GDP growth for this year, basically a continuation of what we are likely to have seen in 2024. The labor market, we expect to retighten just a modest amount from here to
27.34.
Unemployment rate by the end of the year.
It's quite a big move.
A few months ago, but I think it's much more in line with the data. And we also expect that core PC inflation remains at 2.5% or above this year.
All right, let's see if we're onside or offside.
Now, we do have tariff effects built in there.
The Fed is going to speak real soon. Let's see if we're onside or offside. Let's see if we are onside or offside.
25% tariffs on Canada or Mexico built in. We're going to learn a bit more of that over the course of this weekend, and those are upside risks to our inflation forecast.
That's just how much the outlook could change after the weekend. Matt, appreciate it, sir. Matt Lazzetti there of Deutsche Bank, going into this news conference with Chairman Powell. Again, if you are just joining us on Bloomberg TV and on Bloomberg Radio, the decision coming from the Federal Reserve just 24 minutes ago. Rates unchanged, but in the statement, most economists and most strategists look at that statement and assume there's a bit of a hawkish tilt, a hawkish bias in that, relative to what that statement looked like last time around. So off the back of that, equities lower, near session lows on the S&P were down by 0.8%. Similar move on the Nasdaq. In the bond market, Lisa, yields are up about 2 basis points. Going into this decision, coming out the other side, we're up about 5.
So not a massive move. Still, people taking note that this is a labor market that is, quote, solid, not necessarily weakening.
Brian, what's happening, my bro? How you doing? You good? It's good to see you, man. It's good to see you.
Not as much progress made in the press conference.
Good to have you on the live stream, my bro. How you been?
We heard from our panel. I think that they are very important questions. Number one, what would it take to hike rates at a time where potentially you could end up with that really disrupting markets?
We're pretty bearish right now. This picture here, I've seen it quite a few times with gold, so it might just blip lower. But to be honest, because the Fed is speaking, we've got to wait. We've got to wait till after. But I know some of you got balls of steel.
Well, we'll find out in 5 years when the transcripts come out. My sense is that there probably is, a very wide range of views right now on the committee, probably more about the scenarios than the current position. I don't think anybody was secretly wanting to do anything today other than hold. But I do think of a committee with different backgrounds and perspectives, and I think as they start to drill down, as Lisa said, on specific scenarios as opposed to placeholders, it could be a very lively set of internal discussions.
This goes back to the Ben Steele essay today in Barron's. I mean, the scenarios, as you mentioned to begin with, the data dependency is everything.
Tom, why can't you find out in the next couple weeks? Invite them on. Ask them these questions. Ask them if they know.
4 minutes, 4 minutes.
Okay, and he was
Guys, if you're watching the live stream right now, drop a like on the live. Drop a like on the live.
It's out there in the dynamics of tariffs. We don't have. What are we going to do with a 25% tariff? Name a country, John.
Canada.
Canada. Talk to Christopher Friedman, right? What does that mean at Columbia with a piece of chalk in your hand? To see that 25%?
Well, yes, you would notice it. I think the challenge for markets, I really have this sense that part of the financial conditions story right now is that the more outrageous is the headline number, the least likely it is to actually stay in place for very long. I think most people think of this tariffs as being more of a bargaining chip than a battering ram. But again, uncertainty.
All right, so let me talk to you guys about the fundamentals, yeah, for a second. So right now, the statement that we've gotten so far is pretty bullish. In the sense that there's no real need to. How do I explain this in the easiest way possible? Basically, they're thinking, you know what? Inflation is okay. It's not something that's pressing at the moment. And it doesn't want to reduce the interest rate so much and so quickly, where there's going to be an over easing effect on the economy. So right now, it's basically like them sitting on their hands. They're trying to see better price before they make a decision. I hope that makes sense in a kind of simplified version. Brian, what's going on, bro? You gone quiet? Where you at? Where you at, Brian? Talk to me. What are you looking at? All right, 1 minute, 1 minute, 1 minute. Bitcoin's just been dropping. Bloody hell. Let's see. It's about to go down. News conference is starting, guys.
We're down by 0.9% on the S&P. Bond yields creeping higher across the curve on a 2-year, 10-year and 30-year. Just a little bit more hawkish than we expected, Lisa, in that statement.
At a time when they had at one point been concerned about a labor market that was supposedly weakening, now evidently it is solid. That is not the concern. Inflation on the margins, still a preeminent concern. How does he dovetail that in terms of what could tie the difference between possibly a cut or a hike?
The first news conference of 2025. Here's the chairman of the Federal Reserve.
Okay.
My
Powell's
colleagues
here.
remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters.
Wow, huge push on gold.
Financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
We still need to test that 4-hour low.
We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably,
it's still pretty bullish so far, to be honest.
We can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we'll be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years.
I think we're about to see
in determining our findings.
The direction for today or the rest of this
evening. We intend
evening.
to wrap up the review by late summer. I would note that the committee's 2% longer-run inflation goal will be retained and will not be a focus.
We just created a new high there on the DXY.
The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-run inflation expectations well anchored.
Shorts will continue.
Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve. Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or from to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a three-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
Three questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
All right, cool. So far, EU is holding this 5-minute imbalance. We're going to see if it can push through it. Gold at the moment, I'm still pretty bearish on gold. However, we have come into this hour area here. Right. We've already filled the 4-hour imbalance, which was the main target for today when we were trying to sell earlier.
Markets never sleep, and neither does
So let's see.
interactive brokers. Discover more opportunity.
I don't think that my assessment really has changed.
We're getting a crazy turnaround here on the DXY.
More strong data, but we've also seen.
What do you want to do? What do you want to do?
Could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending,
Doesn't look like we're going to get a move today, you know, or tonight.
variables. We're seeing the economy move toward 2% inflation, and
Because here's the thing, right?
has moved largely.
Now that we're starting to turn around,
So we really look at the
right,
toward the goal there.
we now need to look at the liquidity resting beneath and see if price wants to hit that. So vice versa, even if we look for a buy move on gold,
For that reason, we're going to be focusing on seeing
right, 40 pips is not even enough to cover this whole minute candle.
some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive?
This is such a typical red folder day.
Would you judge
Just such a typical red folder day.
meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the issue.
What a turnaround, says Gift. Tell me about it, bro.
We want policy to be restrictive enough to continue to foster.
Look, we need to see if we're onside or not. That's what I'm looking for. Are we onside or not?
Further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say.
Right, gold has pretty much failed to break this area.
We don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested, more positive readings. So I think policy is well positioned.
20 minutes.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
Just been stopped out in profit.
So let me look. If you just look at the first paragraph, we did a little bit of language cleanup.
What a turnaround.
A reference to since earlier in the year as it related to the labor market. And we just chose to shorten that sentence. Again, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit.
Gold's pumping.
But not at the longer run, which
absolutely pumping.
Could be related to what you mentioned, some of the new policies. I think
it's crazy.
Very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, and actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes.
Oof, look at EU.
Administration. We'll patiently watch and understand.
Look at EU. What a turnaround.
You know, kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Eurostat is rebounded. S&P is rebounded.
Michael McKee from Bloomberg Television and Radio.
Because look, here's the thing, right? Could take a buy out of this 2-minute candle here, right? But it's a pretty big candle.
Is it fair to say that since there's a lot
right, 60 pips.
what this administration's fiscal policies are actually going to be, that you don't have a medium to long
The thing is, you never really want to get caught up in a Fed day, you know, buying and selling, selling and buying. Like, you don't really want to get caught out in that.
is going to happen in the economy, how you see it developing?
Because the thing is, on the lower time frame, it's definitely looking like a buy move, but on the higher time frame, it's still a sell. Do you understand what I'm saying, guys? Like, it's still a sell, right? When we look at gold on the half hour,
Beyond just a month or two out. So
we've just tested this half hour candle here.
situation, there's probably some elevated uncertainty because of
Let's take a look at Bitcoin. Wow, look at Bitcoin. Wow. If you get caught in that, that will liquidate you quickly.
So there's probably some additional uncertainty.
That will quickly liquidate you on Bitcoin, boy.
And then we'll be back to the regular.
Like, I still see this as a sell. I mean, let's see what happens on gold.
Sort of just a set of assumptions about
Let me tidy up this a little bit.
placeholder, and meaning, you know, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold waiting to see what comes down. You know, it's a very large economy, and policies affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel the policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you...
We haven't broke this highs, the range, we haven't broken the higher of the range or the lower of the range so far on the dollar.
It's more the other way.
Like, we genuinely haven't.
We are looking at the data to guide us in what we should do, and you know, that's what we do. And right now, we feel like we're in a very good place. Policy's well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And you know, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of
If I had to choose, right?
Right now, we don't see that, and we see things that.
If I had to choose, gun to my head, to buy or to sell gold, to be honest,
we don't need to be in a hurry to.
like, if I had to, in terms of right now, the second, it would probably be to buy gold. But overall, I still do think this is a sell. You know, we've got both a long position, right, out of a point of interest here, and we've also got a short position out of a point of interest, okay? So we had that test of that half-hour candle there. We pushed down, we consolidated, we pushed down some more. We just pulled back up to test that candle. Like, this can definitely still turn around and then drop and make a new low. However, at the moment, we're seeing the dollar continue to be weak. So we could just get a test of that 2-minute candle there and just start pumping.
Answer to your first question, but to the second question, I want to say that.
You know, especially when we look at the high of gold, we did leave Tokyo Sessions high. These two equal highs as well. So there's liquidity resting above these highs.
We are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this.
Jerome Powell is really not trying to give the source away today.
I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Rah, did he just blank that guy?
Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to give our best.
All right, gold is pushing right now out of that 2-minute candle.
That's what we do. That's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see there are alternative simulations. So that's what they do. It'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they
All right, boys and girls. Doesn't look like we are going to get a setup, or we do have a setup right now on gold, this one here, but it doesn't look like we will get into a move for tonight. Things to point out and to look out for is we're still inside of 2 POIs, this half-hour candle here, and also the 1-hour candle here as well. So there's good reasons to buy, and there's also good reasons to sell. In my opinion, on the higher time frame, there's much better reasons to sell than there is to buy, right? But right now, because the dollar is coming down, you may see some more success buying gold for the short term, buying Bitcoin for the short term, buying Euro USD and the likes of most of the majors short term. But overall, it will probably come down. Okay, be careful of this range here on the DXY, right? Because we're not breaking the low or breaking the high. And I don't want you guys to get chopped up just waiting to see what price wants to do. Yeah. I'm going to call the live stream there and go watch some of these footies that's coming out.
I'd say it's the same. You know, we want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think that...
I'm not going to lie, guys. I am itching. I am itching to pull the trigger on one of these moves. I'll be so real. My trigger finger is itching. But it's like, at the moment, there's no point in taking unnecessary risk. But I still do want to pull the trigger. I'm not going to lie, boys.
So you can look through all that and think, okay, then we seem to be set up for further progress. But being seen to set up for it is one thing. Having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. And so it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things. And you put your finger, though, on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment
gold's up.
Is at a sustainable level. It's not overheated anymore.
Dollar's dropping off. Cool.
Cool off anymore. we do watch
Okay.
it extremely carefully. It's one of our two goal variables.
Not gonna lie, boys. There might be a little something forming.
Look at the aggregate.
Look at that 5-minute picture.
It does seem to the labor market does seem to be pretty stable and broadly in balance.
Looks like we might be on the way to get free flow market,
for a full half year.
and then we can target these equal highs. We might be able to get something, boys.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. Unemployment, you said there's a broad range of possibilities, but last September you said, quote, we understand that there's been quite a...
We might be able to get something. Anyways, look, what I'll do is I'll just have a look, set some alerts. As Mark is printing, I see certain things, I'll post them inside the Telegram, send you guys some setups, you know, the usual. If I see something really, really nice, I'll send out. If I don't, then I don't.
And so, but job creation has come down a bit too. So, you know, if those two things come down together, that sort of can be a reason for the unemployment.
Alright, guys, money day, money day, money day. I'm gone.
In other words, the break-even rate as population growth.
Thank you guys for watching. You know, Gift, Bryant, and I think someone else was in here. They didn't introduce themselves, but I appreciate you. I'll see you guys tomorrow.